We want you to plan for success. Welcome to Planning Matters Radio.
Welcome to the show. We're here today with Richon with Richon Planning. He's a master registered financial consultant and fiduciary advisor, serving savers and investors in Central North Carolina for over 15 years. Welcome to the show, Peter.
Well, thank you, Kim. It's good to see you again.
Same here. And it looks like today we're going to be talking about getting our savings back on track. Things we can do when it comes to retirement, emergency funds, where to put our savings. And as we all know, last year was a bit challenging for many, many people with possible job losses and not being able to find the money to put away. So
Indeed. A lot of people got off track in 2020. So whether you're still on track and blessed and lucky to be on track still, or we need to get you back on track, there's a lot to be said in how you are planning and preparing to make that progress. And so really there's sort of three areas where I help people identify opportunities to save more or make their savings more efficient to get more out of the money that they have saved. The root of all financial progress is in budgeting, making sure that you are bringing in more than is going out. And of course, if you take a look at and examine your budget, oftentimes you can find a few extra dollars that you could get into savings. So just the simple act of saving more is something that we help our clients identify where they've got those opportunities. Sometimes that's in reducing fees, sometimes that's in reducing expenses, sometimes it's in reducing taxes, but a lot of times it's just holes in the budget, spending a little extra that we really didn't identify, or maybe if we look at the budget, there's a couple items that we could eliminate altogether. So that's the importance of budgeting. And of course, you can improve your budget from two sides. You can earn more money or you can spend less money. And both of those are controllable, and I think it's a great place to start. From there, the money that we have saved, we want to make sure that it's working a little harder for us, Kim. And right now, a lot of clients are coming to me saying, I am earning less than 0.5% on my money in the bank, on my CDs, on my money market. I've seen as low as 0.01%. And so it's almost an insulting rate. It's certainly not keeping up with inflation. And therefore, even our safe money is losing value. We call it lazy money or losing money safely. There are solutions to that as well. I mean, even in the world of principal protected safe money strategies, you can get a 2.4% guaranteed fixed rate for 3 years. It's available right now. So improving that 0.01% interest rate, 240 times more interest and more growth. 3 years for 2.4%, or 5 years for 2.65%. And then we've got other opportunities that can even give you a little bit more potential for growth, but you're sharing in the gains of the market. You're not risking your money. You won't lose money if the market goes down, but it's got the opportunity to share in a reasonable amount of the gains of the market, given the fact that your dollars are safe, secure, and protected. And then, of course, if you are willing to take a little bit of risk, there's plenty of opportunities in the market, and we can go all the way from a very conservative approach to a very aggressive approach and get your money growing a little bit more for you. And then finally, we help our clients identify in their portfolio overexposure to risk and underperforming assets. And a lot of times when I'm looking for underperforming assets, what I'm seeing is the bonds, the bond funds, and the fixed income is not producing a whole lot of yield or interest, and in fact is more at risk than most savers and investors realize. And a lot of times we can reach into that portfolio, we can replace those underperforming bond funds, we can increase the total returns while decreasing the fees and decreasing the risk.
it sounds like a great plan. And it seems like you work with each individual clients to look at all those individual things, because everybody has set up their investments and their accounts differently. So it's great that you work with them individually this way. So you've already talked about the budget, trying to maximize your savings, finding the right counts. What about your employer plans? What should you do with those?
Well, another great opportunity, right? A lot of people, unfortunately, though, in 2020, they stopped making those contributions. or even borrowed from the account. And so we really need to address that. If there's a match on the table, you cannot afford not to capture that match. I hate the term free money. It's not free money. It's actually part of your salary and part of your compensation, but you only receive that part of your compensation if you put some skin in the game. And if you take your own savings seriously, the company's incentivizing you to earn extra money. So, take that incentive and capture that match. There is absolutely nowhere else in the financial world where you can guarantee yourself that kind of immediate return on investment when you're making a deposit and your employer is matching that dollar per dollar, or even 50 cents on the dollar, or 25 cents on the dollar. That being said, a lot of employers cut or eliminated their match in 2020. So if that's the case, there might be some better opportunities outside of your company plan. And there's many reasons for that. 401ks can have fees. They don't have a great variety of choices and options. A lot of times they're kind of limited in what you can invest in, and the investments sometimes are not the best investments for your specific purposes. Also, you're sort of held captive in employer-sponsored retirement jail. You can't get access to your money. So again, there's reasons to take advantage of that company plan. If your company offers a Roth component of the 401k, that's a fantastic opportunity, and I encourage people to at least explore that. If you don't know, ask your employer if they offer that Roth opportunity. But so many advantages just to making your savings systematic and automatic, out of sight, out of mind. That being said, it's a double-edged sword, right, Kim? Because we don't want to ignore our money. We don't want to have it so out of sight, out of mind that we forget it's there and forget to do routine things like rebalancing. There's a big difference in performance when you pay attention to your money and just do some routine financial fundamentals like rebalance your portfolio on an ongoing basis. Because think about this, Kim, if somebody started their 401k in 2010 and they were appropriately balanced, maybe they had a 50-50 allocation, and then the market went on a tear from 2010 to 2020, market indices basically tripled in value over that time. Well, the at-risk portion of their portfolio is going to now be a much higher percentage of the overall balance. Therefore, you're overexposed to risk. Besides, there's some profit on the table. Let's rebalance the account. Let's take that opportunity while the money's there, while the profit's there, to get you back into proper risk alignment and to capture the profits when we have them.
And that is something you can help them look at if they bring their information to you, and you can help them rebalance and get it all in line for what we're seeing today and possibly coming in 2021. Again, we're here with Peter Richon, and you can reach him at 919-300-5886 or www.richonplanning.com. That's spelled richonplanning.com. So let's get back into this about other ways that we can you've talked about rebalancing, setting your budget, or some people call the spending plan. What about deferring? And you talked about Roth 401ks, or there are the Roth IRAs. What do you suggest for the deferred tax?
Well, I mean, you've probably heard the saying, Kim, it's not what you make, it's what you keep, right?
Yes.
Taxes are usually the biggest thing standing between the two. Right? We make our money and Uncle Sam sees it before we do, and we only get to keep what he gives us after he gets his share. And what a lot of people don't realize is with those tax deferred retirement accounts, they're looking at their budget, or they're looking at their balance rather, and they think that all of that is their money. Well, it's not. Uncle Sam has an ownership stake in that, and he's the controlling ownership stake, meaning he can change the rules at any point in time. Tax rates, tax brackets, they have certainly changed. The rules about how IRAs function changed just last year with the Secure Act. So as much as possible, me personally, I would like to buy Uncle Sam and the IRS out of my retirement nest egg. And so Roth IRAs, Roth 401ks are a great opportunity. Let me put it another way. We know what tax rates are today, and they are historically low. taxes are on sale. If you walk into a department store and you see a full price rack and you see a sale rack and you see the exact same thing on both racks, which one are you going to buy from? The one that's on sale. Well, at the department store, you probably didn't have to purchase that item anyway. But taxes are a compulsory purchase, meaning we must pay those taxes at some point in time. Why not buy them out when they're on sale? And so with our clients, we're doing a lot of Roth contribution and Roth conversion strategies, trying to make sure we're paying the least amount in tax, not just this year, but over the course of many years into the future and over our lifetimes and beyond.
And that's true. We just don't know what's in our future. So it's best to have, I guess, a little bit of money in both, so that if
although the politicians have
20
hinted
years,
at the direction that taxes could go into the future, and they're not talking about lowering my tax bills or yours or really anyone's here. So another great opportunity, Kim, is if you've got an old 401k that's left behind, or you have reached age 59 and a half and you're still working for the company, but want to get those dollars better positioned for retirement, you can do a rollover of your old 401k or even your current existing 401k. You can keep it going, you can keep contributing, you can keep working, you can keep capturing the match, but you can also take those dollars out, roll them over to an IRA. It's not a taxable event, but you can better position those dollars for your retirement.
That's great advice. And what about target date funds? A lot of people.
I'm not a fan.
Not a fan at all.
No, I'm just not a fan. In theory, I like the idea and the concept. It's just unfortunate that in reality, they don't function as they are understood to function. And the reason why is they can't. Law dictates that a mutual fund must stay invested per the prospectus. At least 80% of funds inside a mutual fund is required to be invested. So a target date fund in concept says that we set a date into the future, and as we get closer to that date, we bring down the risk. And again, that's fine in theory. That is an appropriate approach. However, it is a preconceived formula and algorithm that does not take into effect real world conditions. And so if I'm driving around Wake County, around Raleigh, and the posted speed limit on I-40 or 440, the belt line, is 70 miles an hour, on a dry, sunny day, I'm feeling pretty comfortable going 70 miles an hour. But on one of those winter days where North Carolina gets its quarter-inch sheet of ice on the road, the target date fund, and in fact, all mutual funds, are still trucking along at the posted speed limit. They don't take into account real world conditions. So if there's a tidal wave coming, they're not moving to cash. It's not a safe haven, but people believe that, oh, just because I'm close to that target date, it's going to be safer. The largest fund by volume, the most dollars invested in mutual fund, was a 2010 target date fund in 2007 and 2008. So these are people that intended to retire in just 2 to 3 years. Well, that fund lost 32% of its value in the Great Recession. Imagine being 2 years out from retirement and losing a third of your retirement savings. So I think there are better ways to go about it than the target date fund. If it's your only option, it's your only option, and we can still work with it. A lot of 401ks are defaulting to those target dates or those life cycles, but I think that there are better ways to do things.
Now it sounds like it's better than nothing, and but there's other options and stuff. And I know I've heard different people talking about doing several target date funds, because you're not going to need all your money that first year that you retire. So
you can ladder.
Again, there's plenty of plans and different things to do depending on everybody's situation and their risk tolerance and stuff. And talking about risk, what do you suggest about risk when it comes to your 401k? And are people aware of how much risk they're taking on?
No, unfortunately. I mean, you don't just open your statement and it says at the top of it, hey, Peter, you're taking 70% risk and you could lose 35% of your money in the next downturn. It doesn't say, hey, you're paying X dollars in fees in your 401k. There's just a lot that people aren't able to readily identify when they just open the statement casually once a quarter and look at, did they make money or lose money? And that's important, don't get me wrong, but there's a lot more that is important about understanding your investments. It's one of the reasons why I wrote my book, Understanding Your Investment Options. And if anybody would like to get a better understanding of where you can place your money and why each one is appropriate, feel free to give me a call or click the link around this video, and we'll be sure to get a copy of this book, Understanding Your Investment Options, in your hands. It's just one of the services that we offer. And if you'd like a review of your 401k or your investment or retirement accounts, we offer that optimized planning review, making sure that you're paying minimum fees, that you're paying minimum taxes, that you're getting the most out of each and every dollar, putting it to work for you. You've worked hard for those dollars. Once you save them, they're supposed to work for you.
And let's also remind people that there's no minimum that you have to have in your account that could do the review. And if you get started off on the right foot when you're younger, you'll be better off when you're older and hit that retirement age.
Yeah, time is your friend. If you're young and you get started, compounding interest is going to work in your favor. The IRS, by the way, they did realize that compounding interest works in their favor when you defer and delay paying your taxes too. So again, that's a big one that we look at. We look at lifetime tax optimization, making sure you keep as much of your money as possible. So give us a call, get that plan in your hands. It's a simple, easy to understand document. It's usually about 4 to 6 pages. It outlines your top financial priorities, action items you should be taking, a timeline for when you should execute on things, and gives you a good recommendations on how to achieve your goals. Also gives you a great snapshot of where you are now.
Great. And with that plan, you can also talk about rolling over old accounts and maybe your contribution limits with people. And if you have limited options, what you can do when it comes to your 401k.
Yep. I always have more options than you think. And there's some great options available. You just got to keep an open mind to them. There are places where you can have safety and protection. There's places where you can have opportunity for growth. Our motto at Richon Planning is protecting what's important and identifying opportunities. That's what we strive to do for our clients.
That sounds like a great plan and a great thing that you do for your clients. Again, we're talking to Peter Richon at Richon Planning. You can reach him at 919-300-5886 or online at www.richonplanning.com. How about fees? People sometimes don't even realize that they're paying fees in any of these accounts, and then they all of a sudden say, "How come it just went down $100?" Or and I don't even know what this is for. What are they doing for me? Are you able to help?
A lot of times, nothing.
Yeah.
Yeah.
True.
Fees are kind of a part of life, and I don't mind paying a cost if I'm getting a value. But when you're paying that cost and you are really getting literally nothing for it, I do have a problem with that. Again, people are not able to open their statements and typically just readily identify how much they're paying in fees. Another problem I have with the financial world. We can uncover that. We can do a forensic analysis and dig in and find out where you've got these termites eating away at your financial progress. Fees matter. I heard an analogy to fees one time, and it was about an airplane trip. It was a plane that was taken off from LAX, and its destination was New York City. It was 1 degree off of its flight path. And so as it was heading east, by the time it got over Nevada, it wasn't really that far off course. But by the time it got all the way to the East Coast, instead of hitting New York City, its destination, it ends up in Washington, D.C. And so, over time, especially as we compound the difference in 1 to 2 or 3% extra in fees that you're paying over years and years, it will make a significant difference. We help uncover that, often saving our clients hundreds of thousands of dollars over the course of a lifetime.
Great. It's a great idea to go look at those fees and, again, keeping more of your money. Also, with 2020 being a tough year, a lot of people had 401ks or retirement savings, and there is the ability to take loans out. What do you suggest when it comes to loans? And I know there was some
to not do it.
And even if there is forgiveness or whatever, and you can pay yourself back, but
here's the thing though, you're not making further progress while that loan is out. Yes, you're paying yourself back. Yes, you're making some interest on that loan, but you can't make further contributions until the loan is paid back often. And when you have to loan yourself money out of your 401k, it often is an indication of some amount of financial instability. Well, add on to that, if you lose the job, if you change your job, if you try to improve your job and move to a higher paying career to improve your financial outlook, well, guess what? That loan just became a taxable event to you. And so you don't want to have a financial hardship where you're forced to take a loan and then compound that with it suddenly being an extra tax burden. And oh, by the way, if you're younger than 59 and a half, the 10% penalty as well. So the people that did take that loan from their 401k, they technically have 3 years to pay it back. Let's do that as soon as possible.
Great advice. And there's also times where there may not be a great idea to take a rollover or to roll over an account into your current 401k. Can you expand on that? And what are those scenarios that you wouldn't want to roll over a former account?
So I get a question a lot of, should I roll my former 401k to my new employer 401k? Typically no, because you're trapped with the same set of problems where you've got limited options, potentially higher fees, potentially you can't access or do as many proactive things with your money. And so you usually want to roll it over to an IRA. Now, there are a couple exceptions to even that. If you have company stock, highly appreciated company stock inside your 401k, or if you're planning on retiring before 59 and a half, you really need to consult an advisor before making that move. And doing a rollover is not a difficult thing, but it is something that you don't want to mess up. It can have an expense for doing it incorrectly. So I would say consult a professional, talk with your advisor to roll over those old retirement accounts.
Great. And I know there are some people that are thinking they're doing a great job. They are maxing out their 401k. And I've had people tell me, yeah, I'm maxing out my 401k. I'm like, wow, you must be putting like 20% in, 30%, depending on your salary. Can you go back to like what really means to maxing out your 401k versus maxing out the match? And what you can do if you want to make, say you are maxing out your 401k, and what you can do to save even more in your retirement accounts.
Well, yeah, unfortunately, all retirement accounts have limits and limitations, right? Your IRA, it's relatively low. If you're under $56,000 a year, if you're over $57,000 a year, that's not typically enough to provide for a well-funded, fulfilling retirement. So the 401k is beneficial. It allows you to save more. If you're under 50, $19,500 a year. If you're over 50, there's a $6,500 catch-up. You could get $26,000 saved per year. If you're maxing out the match, that's one thing. But really, we need to be earmarking about 15% of our gross pay going to retirement accounts, because retirement's expensive and retirement's long. And so a lot of companies don't match 15%. So you really want to target 15% gross income going somewhere into retirement accounts, capture the match first. And then a lot of times we go outside of the 401k to give us more control, max out your IRA options, whether it be Roth or traditional, hopefully Roth. And then if you need more room than that, go back to the 401k. Now, a lot of people want to supercharge their retirement savings. They are contributing that $26,000 a year and still have the opportunity to save more. That's when we look at other options for just non-qualified investment or other places we could earmark for dollars to be saved, put to work for retirement and for your future.
Great. That's great advice. And I think that's everything we've almost want to talk about today, and coming up with a good savings plan for the future or starting in 2021 if you haven't already started. At Richon Planning, they've been serving savers and investors from Central North Carolina for over 15 years. You can come up with your own plan, work with Peter, and everybody's plan is going to be a little bit different. No two plans are the same. Reach out at 919-300-5886 or at www.richonplanning.com. Peter, is there anything you'd like to summarize? And one last thing to remember for people listening right now.
Well, it's a great time to get back on track. Never a better time than right now to take your financial future seriously. Again, a couple offers. We'll put that optimized retirement plan together for you, looking at fees, expenses, taxes, how to maximize your savings and available sources of lifetime income like pensions and Social Security, and then how to know when you have enough to retire. And if you'd like to start with the book, Understanding Your Investment Options, happy to get that in your hands too. Give us a call, 919-300-5886. Click on the link anywhere around this video. Visit us online, richonplanning.com. We're here to help you protect what's important and identify opportunities. And we always appreciate anyone who is taking their planning and their financial future seriously. Look forward to help and assist.
Great talking to you today, Peter, and look forward to talking to you again in the future.
Thanks, Kim.
This has been Planning Matters Radio.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.